I'm here to talk a little bit about the tax group that my colleagues in finance and economics with me are building. So our big name is the Stanford Initiative for Business, Taxation and Society. Our short name is STAX, which actually doesn't equate to the same letters here, but it's just STAX for Stanford Tax. So with my colleague Josh Rao, who is a professor in finance and a Hoover Fellow, and my other colleague Juan Carlos Suarez-Serrato, a professor of economics, the three of us here at Stanford are really excited to build and grow a tax group. And our goal is pretty simple. It's not an easy one, but pretty simple. It's to make Stanford the place to go for business tax research. We have leading scholars across these three different fields. And our goal is not only to continue producing the quality of research that we're doing, but also to make sure that our research has the highest and greatest policy impact that it can. And to do that, we're assembling a really phenomenal team of scholars here studying these questions. So again, our goal is to make it, Stanford the place to come for business tax research, with the idea that if there's a question about individual taxation, business taxation, et cetera, from a research or policy perspective, that people start to think about us and our institution. So what I'm going to do today is talk a little bit about our vision for our group, and then I'm going to actually talk a little bit about our research. And to do so, I'm going to profile actually a very brand new working paper that I have. I'll talk briefly about that, but it's related to some legislation that's sitting in the Senate right now. And so, we actually haven't publicly put this paper out anywhere. So I'm excited to tell you a little bit about the work I've been doing over the last 9 months or so, with the goal of this paper kind of coming out publicly next week. Okay, so with that, let me get started telling you a little bit about our group that we have here at Stanford. So again, what our core mission is to make Stanford the premier institution for cutting edge, timely, and policy relevant business tax research. So the core mission of our group is actually to do research across disciplines. And the whole goal of doing that is to better inform practice, policy, and academia. And what is really unique about our group relative to other universities or institutions around the world is that we have scholars working across different fields. So while some schools may have a lot of tax accountants working in the space, or other schools have a lot of public economists, we have scholars who are working, whether it's in finance, economics, accounting, or law, really trying to think about these issues from different lenses to pull together and create and produce the highest quality research that we think is really out there. And so the goal is, by bringing together these insights, bringing together insights from these three fields, we basically provide new insights into policy and into practice. We also, through doing this, hope to grow and develop the next generation of tax scholars who are trained to think in this way about thinking not just from an accounting lens or finance lens, economics lens, but to bring together perspectives from all three of these disciplines. And so what we're doing is assembling a team of both PhD students, pre-doctoral fellows, postdoctoral fellows, and visiting scholars from around the world. And in tandem with training them, we're also working on educating and training our MBA students in the classroom. I'm going to talk about all of this in more detail, but hopefully this gives you a sense of what this new tax center that we're building is designed to do. So this is a profile of my colleagues that are building this group with me. So you've already heard a little bit about me. My colleague Josh Rao, professor in finance. He does a lot of research thinking about corporate investments, financial structure. He's also known for his research on, in addition to tax, on state and local pension systems across the United States. My colleague Juan Carlos Suarez-Serrato works in economics. A lot of his work thinks about both public finance issues and also labor market issues. And so he studied a variety of effects of different tax changes, for example, on labor markets and on government policies. This is the broader team of students that we're starting to build. So we just finished our first year of the Tax Center. And what you see here is a group of people, pre-doctoral fellows, postdocs, PhD students. And a lot of these students have a range of different backgrounds. One person has a background, for example, in electrical engineering and computer science, but has real skills in machine learning. So we partnered her with other people who, for example, came out of working in tax practice just like I did. I was a tax accountant for 8 years at Deloitte before pursuing my PhD. And we think the kind of the intersection of bringing together these different skill sets and background help to elevate the quality of research that we do. All right, so what exactly is the initiative that we're doing? I'm going to talk about this briefly before I get into talking a little bit about one specific research project I mentioned. Well, again, the first is to do cross-disciplinary work. And a lot of people, I will say, talk about cross-disciplinary work, but in practice, it can actually be quite challenging because of the fact that we come from different views and lenses. I personally am working not only with colleagues at the Hoover Institution, but also with colleagues at the law school, colleagues in the economics department, some colleagues in computer science. And for me, these projects have been the place where I've learned the most, but also sometimes the most challenging, simply because we speak kind of different languages and how we think about issues or how we approach them. But through this, we really do believe that we're kind of elevating the quality of research that we can conduct here at Stanford. As I mentioned, we're mentoring future scholars. We do engage in a lot of teaching across disciplines, either together with my colleagues or thinking about different types of students or populations that we teach. And then again, ultimately, all of this is to make sure that we are elevating our research to have the greatest policy impact that we can. Let me tell you briefly about each of these. So, for example, our cross-disciplinary work, in addition to working together, we're hosting a series of seminars during the year featuring leading scholars in accounting, finance, and economics. And we'll continue this process to bring people here to campus so that we're aware of kind of the cutting edge research that's happening, not just in Stanford, but around the world. In terms of our future scholars, we kind of have these internal sessions where we're training them up on research skills. Also understanding what are the current tax events so that we can be on the front edge of all of the research that we're conducting, really thinking about issues that aren't 10 years behind us, but actually hopefully issues that are current today that will inform economic development for the next 5 to 10 years or beyond. We do a substantial amount of teaching. So one of the things that has been the most fun for me since being at Stanford is being in the MBA classroom. I started out teaching core or base accounting, Accounting 210, and taught that for about 7 years. Last year, I migrated into teaching the MBA elective course, Tax and Business Strategies. And that course for me is a real delight because we get to cover a range of tax matters, from personal issues like thinking about tax advantage compensation, thinking about starting your own business. So what's the best form or the best, most tax efficient vehicle to set up a business? All the way to international tax types of issues. As a tax accountant who worked in tax accounting for 8 years, this is really fun for me because I get to bring the technical rules that I learned from practice into the classroom and marry those with an economic framework that we really ground the course in. So I co-teach this class with the economist I mentioned earlier, Juan Carlos Suarez Serrato. So we're trying to bring kind of 2 different lenses to the material inside the classroom. My colleague Josh Rao has taught a public policy lab for several years here at the business school. This class thinks about urban governance in US cities. The goal of that class is to bring kind of financial type of issues to different types of to cities by working directly with them as partners. And then we also do a wide range of teaching. I've taught several sessions on taxation in the executive education program. We also teach PhD students both in the accounting group and also in the economics group. So we're trying to translate what we're learning in the research into the classroom through these different avenues. And then I keep talking about policy and practice. Really the goal of all of this is to help, craft better tax policy at the state, at the local, at state and local, at the federal, and hopefully at the international level. And so in our first year, we really kind of made some small steps forward, and we're really hoping to progress more on this in our second year. We hosted a panel on business, government, and society at a big conference that we had here on campus back in April. We brought together a variety of views from practice. For example, the former international director at Meta, the head of a number of views from policy, so people who worked in the US Treasury and at the California Department of Tax and Fee Administration, and people who work in other policymaking roles like at the OECD. And then we have ongoing engagement with policymakers in DC and across several US states. I'm going to highlight some of those as we go through the research here in a minute. So those are kind of high level, the pillars of our group that we're hoping to grow. So what exactly is the core of this? Well, what makes us quite different than I would say like the Tax Policy Center or other just foundations is research. The central core of our group is producing high quality research that is very data driven, data intensive. The goal is not only to land it into a top academic journal where it will be viewed with respect and prestige, but also to get it outside of the academic halls into policymakers' hands. And so we focus our research really in 4 areas. The first one is federal tax policy. So things that, for example, obviously pertain to one country. Obviously, that primarily focuses on the US, but I've also done some work focused on UK rules as well. State and local tax policy. So thinking about issues, say, for example, in California, right now with the group with Josh, where we have contacts or ongoing projects in over 10 different states. International tax policy. So thinking about how are the policies that are crafted perhaps in the US, how do those interact with international rules? What are the incentives that we have in an international tax system? And then finally, and increasingly thinking about environmental and energy policies. And you can probably understand that the majority of the way that governments are trying to address different types of environmental concerns is often through either taxes. So you could think about in Europe, there's been a heavy dose of things like an emissions trading systems, even carbon taxes in places like Sweden or certain provinces in Spain. Whereas from the US side, instead of using more of a stick approach, they're using more of a carrot approach. So a lot of incentives that came through the Inflation Reduction Act were actually tax types and tax incentives to motivate the US to really, in US companies, to invest in green types of technologies and investments, hopefully to lead the way in innovation in that space. All right, so I'm going to highlight 3 different research projects just to give you a sense of the type of research that we're doing. And I think we selected these projects because they're extremely timely and really informing a lot, or hopefully, informing a lot of the policy that's currently being discussed or debated. I'm going to start actually with a federal tax policy. This is a project I've been working on very intensely. Spent my July 4th weekend working on this project with the goal of getting this out over the next week or so. So we have not yet publicly posted this project anywhere. We haven't done any kind of press or communication push on it, but hopefully that will all be coming out in the next couple of weeks. The reason we think this is pretty timely, and I'll talk about what we're studying, basically the tax treatment of innovation, is that there's a current piece of legislation sitting in the Senate. It was passed by the House in January and February. It's currently sitting in the Senate waiting for some type of legislative action to basically fix an issue that came into the tax code. So what I'm going to do is tell you very briefly about what this issue is, and then I'm going to tell you about what our research has found. Okay, so generally what this is looking at a surprise rule that came in place in 2022. I say surprise because it was never supposed to come into place. And the idea is that with this rule, companies that used to be able to immediately take an expense or get a tax break for their R&D activity, now can no longer do that on an immediate basis. Those deductions have to be spread out over a series of years, but by doing that, it reduces the present value benefit. And by our calculations, it can reduce that benefit by almost half. And so the key thing that you should think about with this tax issue is it basically is a huge cut in the tax benefit for doing R&D in the US. And this is a very, very substantial change. So you can imagine that, let me give you an example first, and then let me put it into a bit of context. Let's say that you are a startup company and you employ a lot of programmers who are helping to develop your product. Well, now those programmer salaries used to be deductible as R&D, or at least some substantial portion, if they're working on R&D, would be deductible immediately. Now, under this rule, you can only deduct 10% of their compensation in year 1, and the rest has to be spread over time. So there's 2 key issues that happen with this change. One is that immediately, if you were planning on 100% deduction and now you only get 10%, your tax bill is probably going to go up by a lot. And the second is this present value effect. So even though the nominal amount or the total deductions you get over time adds up to the same amount, because it's pushed out into time, the benefit of that goes down. And we have a lot of research on other types of investment policies suggesting when you spread out benefits like that, it can really change a company's investment patterns. Now, I gave you an example of a startup company. Let's also think about really big multinational companies that conduct a lot of R&D. They actually probably conduct the majority or the proportion, large proportion of R&D in the economy. This really is going to impact those firms. And those are the companies that we have data on. Those are the companies that we're going to study in this setting. Okay, so this is a surprise change that happened. And the reason why is it was actually passed back in 2017 as part of the Tax Cuts and Jobs Act. So if you think about the Trump tax cuts that were passed in December of 17, there were a lot of really business favorable provisions. The corporate income tax rate went down. We got a much better international tax system. We provided benefits for partnership and S Corp type entities, et cetera. So while all of those were very business friendly, they also cost a lot of money. And so in order to compensate for those provisions, the lawmakers had to come up with other things they would change to make the math work out at the time that the bill was passed. And so what they said is, well, let's change the benefits for R&D. We're giving all of these other ones, so let's reduce the benefits for R&D. But because, in my personal view, that's a crazy policy. Typically, we don't want to discourage innovation activity. The start date or the implementation date was kicked until 2022. So again, there were all these provisions that happened in 2017 that took place immediately, but the policymakers said, let's defer this start date until 2022. And with basically under the idea that this would never really come into play, that Congress would step in and fix it later, but at least in 2017, it would help make the math work. And there's a lot of rhetoric about how this was never supposed to come into action. Unfortunately, Congress never fixed this. And so what we saw is in anticipation of the change, companies really saying, please fix this, please fix this. And by the end, basically, of 2021, right before it came into effect, there was no legislative action. And so here's one quote just talking about this particular setting, saying, if this sounds foolish, this change, that's because it was never intended to actually happen. The law's designers expected policymakers to revisit the matter before any harm was done. Congress just never got around to it. Okay. So what we're going to do is basically look at this change and try to see what actually happened to companies when we take away, whether it's inadvertent or not, but when we take away this tax system or tax benefit for innovation. And as I mentioned, we think this is extremely timely because there is this current legislation that's sitting in the Senate awaiting a vote. And I can provide more context around why there hasn't been any action on it. In very brief, this piece or changing this has broad bipartisan support. Both Democrats and Republicans agree that this should be changed. It is more business friendly, so typically it's getting more support from the right than the left. The left really wants to make sure that they can get an extension of the child tax credit through. So there's legislation that has both of these components. So both sides should be bought into the legislation, but we just haven't actually seen any movement on the bill since it was sent to the Senate back in March. Okay, so what we're going to do is look and see what actually happened when we take away as a country, basically incentives for innovation. And before I show you these results, what I want to say is why we care about this is because while we're taking away benefits for innovation, a lot of other countries are doubling down on benefits. So China's providing super deductions for innovation. In Europe, I know we have some people, for example, dialing in from the UK, from the Netherlands. There are much greater benefits for innovation through things like patent boxes and innovation boxes. So from a geopolitical perspective, it seems like we're almost kind of shifting in a different direction than the rest of the world, at least in my view. Okay, so what do we find? Okay, so these again are kind of new. We haven't put these out there before, so we'd be really grateful for your feedback or thoughts on this. First of all, what we show, so we go through, we look at all public companies. We read all of their financial statements, and we figure out who is most impacted by this. So we want to make sure we're picking the companies, not just that have R&D expense, but they actually say something about this provision. Now, of course, what that means is we're slanted towards a subset of companies that are probably most impacted, but it also confirms that we're not estimating an effect on companies that really this didn't matter as much to them. So for the companies, which is almost 600, the biggest multinational companies you can imagine, we find they have to capitalize around $375 million of R&D just in the first year alone. And in total, that's around $45 billion of difference from 2021 to 2022. Now, just for context, Congress estimated in the first year, their estimate was half of this. So just among the sample firms that we have, which again is not the whole economy, but just the kind of, a big sample of really big companies, our estimates are twice what Congress, estimated would be the impact of this law. Now, beyond that, what we see is that the company's tax liabilities went up by almost 60%. And that's because this R&D deduction gave such a huge benefit to companies beforehand. So in total, their tax liabilities go up a ton. That's a very unexpected and surprising shock in 1 year alone. And in response, we see that among groups, different subsamples of companies, that they're cutting R&D by about $12 billion. Now, we actually weren't even sure we would see this cut in R&D because we're looking at pretty immediate effects. It takes a long time to adjust R&D. People were really hoping that companies would change, or that Congress would come in and change the policy. So the fact that we see such a big immediate effect is, a sign to us that this is really, really, really a huge change to companies. It's really biting in terms of hurting them from a cash perspective. And in order to compensate for that increased cash tax, we see a huge decline in R&D. We expect those benefits to continue and to grow as the law remains in place and as more and more R&D dollars basically no longer have this tax benefit. So this is kind of the initial response that we're seeing so far. Other things that we see, in addition to compensate for the increased cash taxes, we see companies also cut other types of capital investment spending, so not just R&D, but capital investment. And they also reduce shareholder payout. So we see a reduction in the amount of share repurchases that are happening because that's kind of a more flexible margin along which companies can adjust. So, kind of to summarize here, we're looking at a very relevant, very recent change. We're showing pretty substantial effects on a huge increase in cash tax liabilities. And then I think even, beyond that, we're showing this really, pretty sizable cut in R&D among an immediate change. So let me pause there. I don't know, Allegra, if there's any questions. I can keep moving, but I want to maybe pause for a minute or two at this point.
There are, and I think the most salient one right now is, why would this bill have been introduced in the first place?
Back in 2017?
Mm-hmm.
Yeah, so part of the reason that this came up is because the Tax Cuts and Jobs Act that was passed during the Trump administration, it was actually really expensive. So traditionally, what we've seen over time with tax bills, if you think about tax bills typically during a Republican administration, they're what we call revenue neutral. So whatever basically new incentives get put into place are typically compensated with cuts in other things to make it, make the net cost zero. In the 2017 bill, was actually quite expensive. It was not revenue neutral. The initial estimate of the cost of the 2017 bill was $1.3 trillion. So it was already in a place where the benefits that we were providing were greater than the benefits that the Trump administration was providing were greater than basically the cuts that were happening on the other side. And so, basically the administration and Congress was trying to get the cost of the bill down as low as possible. As just one example, right now our corporate tax rate is 21% in the US. The original proposal was for 15%, but that was so expensive, the administration and Congress then creeped back up to 20%. But they still needed more revenue, and that's why we're now at 21%, because they just needed more revenue to offset some of the cost. This came up because they were trying to find revenue wherever they could. This was introduced as a way to further reduce the cost of the bill. So even with things like this R&D incentive, even with creeping the rate up to 21%, it was still a net cost of about $1.3 trillion. One of my research assistants likes to call this a phantom policy, in the sense that it was put in place, but never actually intended to come into place. It was like, let's just put it in to make the math better, and then we'll fix it later. And the problem was they never got around to fixing it later. And so now we're kind of in this position where companies are subject to this pretty terrible, in my view, terrible policy because of the fact it was never fixed in 2021.
Wonderful. Now you might get to this a little bit later, but I do have questions here on how, I know this is still a working paper, but how are you planning to present this information to policymakers?
Absolutely. We definitely want to get it out. And that's why we've been working pretty quickly and earnestly on this paper. I mean, quickly, 9 months is quick for an academic, But you can imagine we started with basically going through every company's financial statements, meaning reading through, using different machine learning tactics to identify keywords and reading excerpts, then going and actually collecting each company's individual amount on how much they were impacted. So we started that back in August and have continued working and iterating this paper. Our goal is twofold. So one is that we're already in conversation kind of with the Stanford communications team to do a number of press pushes on this. So our hope is to actually get this in the hands of one or two journalists within the next week, and hopefully they can write about this. There's been basically one very prominent journalist at the Wall Street Journal who's covered this a lot, but try to get this in the hands. So we're going to try to go through the press route. And then we also are going to hopefully work through our connections through the Stanford Institute for Economic Policy Research and some other connections in DC to get this into congressional hands. But I'm sure the audience I am speaking to has many other connections, and I would welcome those if there's a good channel through which we can make sure that we really get these findings out there.
And I think maybe the last one for right now is, do you think companies are really cutting R&D, or are they just reclassifying it?
That is a fantastic question. We thought potentially they were reclassifying it. So we did some tests around that. Now, I will say that the data that we have, again, it's just public data. So we don't have, internal company records. We just don't have access to that. But what we do have is basically the classification of their expenses on their income statement from their financial statements. So from their, say, 10K. So we look to see, do we see it come down in certain firms? R&D comes down, but say, for example, other categories go up, which is a pretty natural and frankly an expected response. We don't see that effect happening. That doesn't mean maybe it's not. We just can't statistically detect any, significant enough effect that we see that happening in our sample companies. Now, certainly, I think to the extent that this continues on, and as we basically look at the first impacted companies that had a December fiscal year end, but as later fiscal year end companies see that it's not changing and start, responding, I definitely think that we could see even more of that impact happening. So as we get more data, as we extend the study, this is a test that we have done before, but that we will continue to revisit because I would expect certainly some companies will do reclassification.
And Jim asks, from the companies that you viewed, were there layoffs associated with reduced R&D expenditures?
So a lot of the press coverage, particularly among very small companies, was that there were layoffs. So if you imagine, take that startup I talked about, if all of a sudden they have to have this huge increase in tax liabilities, the press coverage among, 2 or 3 small companies that they interviewed suggested that the companies were actually cutting employment as another way to compensate for that. Now, I think 2 things. One, we tried to look at employment among the very large public firms we have, or we did some tests of that. We don't see any change, but I think that's in part because the companies seem to be adjusting on these other margins. I do think that the companies that likely where employment was really impacted are these smaller private firms, and we are trying very hard to get data on them. I definitely think, at least from the press accounts, that there could be a reduction in workforce because of this. I think that could have happened, but we need more granular data than we can get publicly right now. So we're trying along a few dimensions to get some access to data about kind of how these small companies responded, because I do think that the workforce effects could be found there.
Brian asks, is the Senate legislation retroactive? And if so, how does that make sense in incenting R&D?
Yeah, so it is retroactive. So there's a provision. I was looking at the legislation even just as recently as last week. I think it's in subsection E11 or something like that, that basically says in the legislation, it will go back to effectively what was in place in 2021. Now, even if there is this retroactive piece, companies are still out of pocket the cash, right? So they might be able to go back and claim deductions and get some refund, but to some extent, they had to come up with the cash in 2023 to pay for this increased liability. So the retroactive nature will help improve or, make it, less awful than it was, but these 1-year effects that we're documenting are still in place. So yes, companies might be able to recoup the cash down the line if they make the change. Now, what I have heard is that some people in policy have said, well, it's been in place and like the sky hasn't fallen. So maybe it's actually not that bad of a policy. Maybe we should just leave it in. And I think that's where our paper is really trying to say, actually, there are some really negative effects that are happening. I think they're hearing about it from companies. The corporate lobby has been pretty strong around this. What we try to take a step back and say is, let's just go get the data. Let's take the data, try to understand really what's happening in the data, and then let the data that we're seeing really tell the economic story of what's happening in the economy. And we're hopeful that that will, give everyone a little bit of, actual real numbers to kind of sink their teeth into beyond just a company or a few companies covered in different press accounts.
Can you talk more about the breakdown of the companies you sampled by industry group?
Sure.
He's particularly curious if the policy impacts pharma companies or tech companies more.
So we haven't compared tech versus pharma, but you can imagine both of them. I mean, we have a strong our sample includes a lot of tech firms and a lot of pharmaceutical companies. So I can't tell you which one is bigger relative to the other. It's actually a great question that we should do more on kind of an industry breakdown by it. But the companies range from, I think two of our appendices that we have in the paper. One is Microsoft. So of course, they're doing a lot of R&D. Actually, another example people are always shocked by is Chipotle. So Chipotle, for whatever reason, does a lot of R&D. That makes me, frankly, a little nervous about the burritos that I might eat from Chipotle. But they were pretty substantially impacted. They have a very clear financial statement disclosure about the effect of this on their tax liabilities. So definitely tech, definitely pharma are in our sample, but there are also a lot of companies that you might not think about, right? Like a Chipotle type of firm that also are hit by this, because if you're doing any amount of R&D, you're going to be affected. Okay, so thank you very much for the questions on this. So that's just an example of, a federal tax policy paper or federal tax question that we're thinking about. I want to highlight two other projects that my colleagues are also working on that I think are extremely timely as well. So my colleague Josh Rao has done a lot of work thinking about state tax obligations on individuals. And he has had access to individual tax data in California. And broadly, what he's looking at in this project here is when California tax rates on individuals go up, what happens in terms of migration of taxpayers. And so what he's showing here in this paper is that basically when the marginal income tax rates go up on upper income taxpayers, call it 1 to 3 percentage points, there is a huge response in terms of outward migration. So we see in his paper, what he shows is that he sees taxpayers among the high net worth taxpayers leaving at an extremely high rate in response to these higher tax rates. Now, maybe that isn't as much of a surprise to you all, but I do think that there is this idea among some policymakers that we can just increase rates and there is no what we call behavioral response, that people will just pay at those higher rates. And what Josh's paper has been so influential in showing and quantifying is the extent to which people leave. So we already know California is very high rates, but he's really been able to say people are leaving at an extremely high rate. And beyond that, he can show where they're going. And they're going to places that you would imagine, lower income places like Florida, like Texas, like Incline Village in Nevada. And so I think his paper has been really impactful on the individual tax side and helping the state here in California think about their policies. Now, hopefully what we would like that to translate into is a more thoughtful or different types of marginal tax rates that are imposed on individual taxpayers. But certainly, at a minimum, this has started a discussion between his research team and his broader team and our broader team with the state kind of about these policies and rules. This is just one, I want to highlight, this is just one of many ongoing projects that we have at the state and local level. I'm doing a lot of work, not just with some other agencies in California, the California Tax, we're just starting now, work with the California Department of Tax and Fee Administration through our affiliation with the CPR institution here on campus. I'm also doing a lot of work in the state of Alabama, where they've been really willing, been fantastic government partners with us to understand the extent to which the government gives incentives to businesses and how, to what extent does that actually help with economic development. We also have ongoing projects in Texas We have discussions with some people in Hawaii, North Carolina, Massachusetts, Indiana. I can list several other ones, but we think that this is kind of a really interesting place to understand not just policies, but competition across jurisdictions, and the extent to which tax policy is a tool that's used for competition. So let me pause here, see if there's any questions from this individual or the California perspective.
Greg asks, do you think taxes will ever be increased? Our debt is at 34 trillion and continues to grow. Is this a huge concern? Does it bother you?
It definitely bothers me. And that's actually the first day of our tax and business strategies class that we talk about, I bring in all of these statistics basically about the, national debt levels, our commitments in terms of entitlement programs, with the liabilities are kind of, increased. Just think about Social Security, the increased liabilities, increased other, sources of, or other debt sources that we've had, and the reduction. So, at some point, as an accountant, obviously, like the revenue is going to have to equal the expenses. I don't think the answer is just continuing to cut taxes. I mean, I think that there are a number of places where tax policy can be done more thoughtfully. Even if I'm just going to go back to R&D for a second. So, that policy is removing the benefit for R&D. At the same time, the U.S. has put into place things like the CHIPS Act or the IRA that are trying to motivate R&D. But it's kind of like this, one incentive goes in and another one comes away. I would like to believe that we could have a bit more of a holistic or thoughtful policy. So maybe we don't need, 10 different policies or 10 different tax provisions or different tax cuts. Maybe we could just have an overall one targeted policy. And perhaps that could actually be some policy that, yes, is an incentive, but when compared to 10 one-off policies, might actually lower the cost or, increase more revenue for the government. So we can't just continue to cut taxes. That is completely unsustainable. But what we do need is some type of more holistic, thoughtful approach to the policy that I do believe could be both, not negative to business, not negative to individuals, not induce these kind of inefficient outward migration practices, and also hopefully raise some revenue. And I think we see that playing out actually in the two political candidates' platforms. So the President Trump's platform, it's actually been pretty thin on taxes so far. The most recent tax issue he's been talking about is just removing the tax on tips, which generally most economists think is not really the most efficient way to provide tax policy. But he's been thinking about basically an extension of a lot of the tax incentives that came in 2017 that are set to expire in 2025. Whereas the Biden administration has basically said, look, the corporate rate's going to have to go up. And I think that's really in response to exactly this question, which is that we need money. We need money to pay for things. So I don't think, my personal view is the answer is not just cut taxes. I think we need to really think about what is exactly the policies or the incentives that we want to, or activities that we want to motivate. And instead of providing like a shotgun approach to a whole bunch of different policies, have like one or two really targeted ones if possible. That's an oversimplification. I'm an academic, not a policymaker, but I do think there's a path forward that would also hopefully help address our debt issues.
We have two differing opinions here in the questions. One states, it seems intuitive that when you tax higher earners, they move, talking about the migration out of California. And then we have the question, but how about a wealth tax? Do any countries do this? Could it work in the US? Yeah, so does sound intuitive. Like we should, from, I think one response or this response to Josh's work is like, we should know that they would move. I think what his paper was trying to show is, yes, it's true that people would expect people to move. What his paper was doing is really quantifying like how much outward migration were we having and among, exactly which taxpayers. So that was trying to take it beyond just like we shouldn't have higher rates to actually thinking about who are those people that are responding and then quantifying what is the revenue loss of those taxpayers. So to some extent, you could argue this is trying to like provide the facts that support kind of the intuition we think, but beyond just showing that, quantifying it. But it's a very fair comment. The wealth tax. So this is, something that's talked about quite a bit, especially kind of on the left platform and thinking about an alternative source of revenue. There have been other countries, for example, I believe in Scandinavia, that have a wealth tax. I'm starting to work on a project with someone who has Norwegian wealth tax data. And so we're trying to understand actually how do individuals respond to that wealth tax.
when it gets put into place, does it change where, for example, did it change where they report or where they own certain assets? I know of another paper that shows that there's just a movement of assets out of the country. One of the biggest challenges that I think we would have towards a wealth tax is actually coming up with that base, right? So if you think about an income tax system is it's on the income you earn. That's like you clearly earn that income, it's reported to you. Even capital gains or dividends, those are actual real transactions that have happened that are reported to you. A challenge with the wealth tax, especially among people who have securities or have assets that are not necessarily shares or held in the capital markets, is actually coming up with that valuation. And so I think that is one of the just more technical aspects that makes a wealth tax more challenging, is how do we actually figure out what somebody's wealth is if it's held, for example, in closely held firms or private companies or in real estate. There are certainly ways to do it, but actually enforcing that system and running that system, I think I would imagine would be a pretty challenging just logistical exercise to do from the IRS's perspective. Okay, so this is a little bit of work on the individual side, thinking about state and local issues. The last paper I want to profile is with my colleague, Juan Carlos Suarez Serrato. So Juan Carlos was a professor at Duke for 8 years, and we were so lucky to attract and to retain him or hire him here at Stanford about 2 years ago. It's just been phenomenal to have him as a colleague, and he is the one I co-teach the MBA class with. And so both he and I do a lot of work thinking about international policy. So we were just a minute ago talking about how states compete, across borders. So do countries, right? Countries are competing basically on how to attract economic activity, how to attract jobs, and even just how to attract income that they can tax. And so this particular paper that we're profiling here with Juan Carlos's paper, he's getting access to the administrative data from the IRS. So he has company-specific data in the IRS. And what he looks at is basically the types of structures that companies create to shift income through different jurisdictions. So one of the biggest challenges that the U.S. Treasury is facing, and many other countries that have relatively higher corporate rates, is that companies just don't have an incentive to actually report income in those countries. They prefer to report their income in a lower tax jurisdiction, like Switzerland, like Singapore, like the Netherlands. And so there has been this huge movement. This is why this paper is so policy relevant. A huge movement by multilateral bodies, so organized really through the OECD, to get countries to come together and agree on some shared principles on how they basically would try to reduce this amount of company or corporate tax arbitrage. And we were expecting rules actually at the end of June from the OECD on the implementation of what's called the global minimum tax. And so there's a lot of questions about how is this really going to play out around the world? If we impose a minimum tax around the world, will it work? Will it not work? I have some opinions about the effectiveness of this policy, but it's all getting made right now. And so papers like this one that Professor Suarez worked on was trying to show what were the kind of structures U.S. companies were using that allowed them to basically have very, very low taxed income. If you are a tax person, you might have heard anything. You might have heard about it's called a double Irish-Dutch sandwich. It's a common planning strategy among multinational companies. Google had used it. There was an article that came out several years ago about that. We thought that was kind of the most common strategy, but we had no idea about how prevalent it was until this paper. So this is really the first paper to kind of unlock and help us understand the extent to which companies are using these strategies. By the way, these strategies are totally legal. They follow the letter of the law, but they've come under scrutiny because people say it's not really the spirit of the law. And so this paper is really trying to shed light on how much of this income shifting is happening, and more importantly, how did it happen, through what structures. And so this is a pretty interesting piece of work that's come out on the international tax side. I do a lot of work on international. I actually started my career at Deloitte working in international tax. So I love these types of projects. It's really interesting to me to understand these questions. And this is an area that Professor Suarez and I are hoping to collaborate on going forward. Hopefully what you've seen is, kind of the different pillars of our initiative. all of these things. What I've really highlighted today is this first one, this cross-disciplinary research and the type of research that we're doing as a group. So we went through a federal tax policy, this R&D policy that I'm working on right now, an individual kind of tax policy around California through Josh's research, and then also thinking about this international tax policies. And as I mentioned, in addition to those three, we also are doing some, and especially Professor Suarez is doing a lot of work thinking about kind of these energy and environmental issues, as well as we see more of those policies get rolled out both in Europe and in the US, or really around the world and in the US as well. So just to wrap up here, in summary, these are kind of, our tax group. Hopefully you can see the excitement that I have, that we have about building this group. We're really excited about this work, and we're really, excited to move forward. So what are our primary goals kind of moving forward to make Stanford the place for business tax research? The first one is to kind of continue and also initiate some new research projects that have direct policy impact. I'm working with the IRS on a number of projects related to partnership taxation with my colleagues at the law school. As I mentioned, we also, through the support of the CPR institution here on campus, we also have a new partnership and agreement with the California Department of Tax and Fee Administration to further get access to unique administrative data to understand questions in California. And then, as I mentioned, we have a number of projects across a lot of other states as well. So we want to continue that. And I would say the biggest thing that we really want to focus on this next year is increasing our connections to policy and practice. So the school has this phenomenal business, government, and society initiative, a broader initiative that covers anything from AI to sustainability and to taxation. So we think we're really in a great place to continue partnering with the school under this BGS initiative in order to try to get the right connections that we need with relationships in DC, but not just with policymakers, also with CFOs and tax directors. So it's very important to us that our research is not divorced from what's happening inside companies. And so we want to continue to try to build on some of the connections we already have there, so that we can have a two-way conversation about our research, what we, what they're thinking about, and how, what our research can inform them as well. We want to continue to develop our team, obviously. So we're growing our team. We're bringing on, there's, I think, 2 or 3 new postdoctoral fellows that are starting. And then our hope is honestly just to increase support for STAX. So through events like this, it helps to increase awareness among the alumni network about what we're doing. So hopefully you start to think about Stanford as the place for business tax research. And then obviously we're working with a number of grants and foundations to try to obtain funding just so that we can continue to expand on the policy impact that we have. So those are our goals moving forward. With that, I will wrap up kind of the formal piece just with a huge thank you for the opportunity. I'm very grateful to have the chance to present the research that we do here, to talk a little bit about this tax center that we're starting, and also to get your feedback on the work. So thank you. And I think with that, we can open it up to any other questions.
So early on, Greg said, revenue neutrality as a principle is not being enforced, nor is budgetary constraint on the fiscal expenditure side. With repeated switching between political parties and congressional control, what does this imply for the future of tax trends, corporate and personal?
Yeah, that's a huge question. I mean, it's true, like we don't have revenue neutrality, in terms of thinking about scoring of tax bills. I mean, we saw that in 2017. There is a huge expansion. I mean, if you think about the Inflation Reduction Act, so let me talk about a bill that was, the Tax Cuts and Jobs Act was, obviously Republican legislation. The Inflation Reduction Act was Democratic legislation. I mean, these were both very expensive pieces of legislation. And I think it goes back to the earlier question, like we can't just continue to give kind of tax incentives without somehow raising revenue in some other way. So I'm not sure that I have the right answer for it. It's very concerning to me. And so when we think about, I would say it's both a challenge and an opportunity. When we think about policies as academics, we usually focus on like one policy. And that's because what we need is basically some event where we can say what happened before versus what happened after. But I think when we take a step back from the policy, we need to be thinking, I think all of us as academics could be doing a better job of thinking about holistically, what does that really mean, right? So if we study, for example, this R&D policy, I think what would and let me just think about this personally, what I shouldn't do is just think about just that. Like, we need to also be thinking about the CHIPS Act that was also passed and the potential cost of that, think about the Inflation Reduction Act, and more generally kind of the R&D policies, so that if we are asked about our opinion around these, it's not just X provision only, it's trying to think about the total cost of all of the different policies. But I think your question is much bigger than that, which is just, what do we do if we are in a place where we're constantly like spending more money or providing more tax cuts that we really can't pay for? It's a huge issue. I don't know that I have the right answer, other than like, we need, at some point, we're not going to be able to continue to give corporate tax cuts and individual tax cuts. We need some type of policy that is going to generate revenue. And I think, usually generating revenue is that hits companies that are either the most profitable or individuals who are the wealthiest. Yeah, and I think what will be the most interesting to watch will be something like the global minimum tax. And let me say why. So the global minimum tax is this idea of like, let's get a group of countries together, right? A group of jurisdictions to actually think about a way we can minimize the arbitrage and raise the relevant revenue that we need. And it's been really fascinating to watch that, because it's the higher, the more developed countries that have higher tax rates, like the US, like Germany, France, who need to generate revenue, right, to run the more developed economies. But they've really had to like strong arm other countries to come and participate in that discussion, because for some of these other countries, tax policy has been the primary way, or at least one of the primary ways to really drive economic development. So if that movement can be successful in actually getting countries together, I think it could potentially be a path forward in how we think about a more sustainable tax strategy. I personally am very concerned about whether or not it will be a success. Success is kind of hard to define, but the US is very unlikely to implement the global minimum tax under a Republican-controlled White House. It certainly will not pass. I would be shocked if the global minimum tax went through. And so then what you're going to have is basically a patchwork implementation. And at the end of the day, who's going to lose is the US, because they're not going to get their piece of the revenue. And our companies will end up paying that tax to other jurisdictions. So I'm very concerned about it, but I think it could be an interesting, specific policy to watch to help think about the questions you're raising.
What are other policies or most important potential taxes that would move the needle, in your opinion, in cutting the federal deficit?
I actually am going to talk not so much about a specific tax, but actually about the enforcement of the tax system. So we have a huge tax gap. A tax gap is the difference between what taxpayers should be paying versus what they're versus what they do pay. And so the tax gap is driven by a lot of different groups of taxpayers. But you could think about, taxpayers on kind of the lower end of the wealth distribution. So they may not be paying what they need to because they work in maybe a cash economy. And then you could think about taxpayers on the upper end of the spectrum who might be not just like planning for taxes. So, planning can be very legal, but the more extreme, like evading taxes, like people using Swiss bank accounts to hide their money and not report it to the US, even though they're supposed to. And so we think a huge piece of the tax gap is driven by by some subset. It's, some subset of upper income taxpayers, but those taxpayers are notoriously very difficult to understand, to enforce, to understand, to what extent are they using hidden accounts, that sort of thing. And so I think a lot of the money that was given to the IRS was supposed to try to kind of work on that upper end. And that's some of the work that my colleagues and I are trying to understand, which is just like, what are the networks of kind of complicated structures that these taxpayers might be using? But I do think that, the increased enforcement could be one way to actually generate revenue. And that gets very political because people have different views on like the effectiveness of the IRS. But I will say that what the research shows about it is a very high ROI on an hour of spent for audits. So in the partnership space, we see a very high ROI. So for an audit that's done, we see that the IRS returns $10 to $20. And so among that kind of, that high net worth space. So again, can become a very political discussion about whether or not money should go to the IRS. But I do think that is one path to actually revenue generation, is having a better system for enforcement. And then certainly I think we have to have a very honest conversation about what corporate tax rate should be in the US. Because I don't think if we continue to drop the rate, even though from an economics perspective, the corporate rate is kind of inefficient, I just don't know that we can afford to do that. I want to say thank you all so much. So many people tuning in and asking questions about tax, which always, typically gets sold as a very boring topic, but hopefully you can see, I love it. I love learning about it and understanding the economic effects. Would welcome any type of one-on-one engagement. Please feel free to email me or my colleagues directly. Thank you so much again, and look forward to hopefully meeting many of you in person at some point.